All right, let's talk about the market action for November 19th, 2025, because it was a really fascinating, kind of perplexing day. We saw this incredible story of conflicting signals. It felt like one force was pulling the market up, while another was trying to drag it right back down. So, what exactly was creating this tug of war? Let's break it all down. And here it is, the central puzzle of the day, laid out plain and simple. On one hand, you had major tech stocks and the broader market finally break a 4-day losing streak. That sounds great, right? But on the other hand, a key indicator of how investors are feeling, the fear and greed index, plunged all the way down into extreme fear. So how can both of these things possibly be happening at the same time? That is the million-dollar question we're going to unpack right now. And to really get it, we need to look at the two powerful opposing forces that were just locked in this epic battle for control of the market today. So let's start with the winning team, at least for today. The force that somehow managed to pull the market into positive territory, the AI bulls. This was all about a powerful wave of optimism, and it was laser-focused on one specific theme. And that theme, you guessed it, was dominated by one thing: artificial intelligence. I mean, the entire market just seemed to be holding its breath for one single event, NVIDIA's earnings report, which was due right after the closing bell. Now, this wasn't just about one company. No, this was seen as a crucial test for the entire AI growth story. And you can see how that anticipation translated into real numbers. Investors, not wanting to miss out, were buying into NVIDIA before the report even came out, pushing it up nearly 3%. And that optimism just spread. You had Alphabet surging on hype for its new AI model and news of a major investment. This enthusiasm was so powerful, it made tech the day's best performing sector and single-handedly snapped the S&P 500's losing streak. And here's the final scoreboard for the day. The tech-heavy Nasdaq, no surprise, clearly led the way with a solid gain. The broader S&P 500 followed suit, but look at the Dow. With less tech exposure, it barely moved. It was a clear win for the AI bulls for sure, but as we're about to see, it wasn't a total knockout. So, let's move to the other side of the rope and see what was pulling so hard in the opposite direction. Meet force number 2, the macro bears. These are the investors who are worried about the big picture stuff, the overall health of the economy. And what was their biggest concern? The Federal Reserve. The release of the notes from their latest policy meeting, the FOMC minutes, pretty much confirmed what many were afraid of. Fed officials are in absolutely no rush to cut interest rates. The whole idea of a December rate cut now seems very, very unlikely. And that higher for longer policy, well, it puts a big brake on economic growth. This anxiety wasn't just a feeling, it was something you could actually measure. The fear and greed index plummeted to just 12 out of 100. That is deep, deep in extreme fear territory. And that risk-off mood, as they call it, sent shockwaves through other markets. We saw Bitcoin, a classic high-risk asset, dive nearly 4% as investors just fled for safety. And the jitters went global. The Japanese yen hit a historic low of 156.3 against the dollar. Now, a move like that sparks very real concerns about financial stability all around the world. And the market's own fear gauge, the VIX, it tells a similar story. While it dipped a tiny bit today, it is still way up there after spiking 38% in just 5 days. This just shows you there is a huge amount of anxiety still baked into the market, just waiting for something to happen. This whole conflict wasn't just about sentiment versus tech stocks. When we look at the actual economic data from the day, we see a similarly divided and, frankly, complex picture emerging. Just take a look at the retail sector. On one side, Target came out with disappointing earnings, which suggests the average consumer is really starting to struggle. But then, at the same time, Lowe's posted strong results from home improvement spending, and the discount retailer TJX thrived as people were hunting for bargains. This paints a classic K-shaped picture, where some consumers are doing just fine, while others are clearly hurting. And this divergence was clear right across the entire market. As we saw, technology was the big winner, but on the flip side, the energy sector was the biggest loser, dropping 1.3%. Now, that was mainly due to falling oil prices on hopes of a supply agreement between the US and Saudi Arabia. So again, conflicting stories absolutely everywhere. So, you've got this perfect standoff, right? The bulls and the bears are locked in a dead heat. How are the experts making sense of this market? And more importantly, what are these suggesting investors should actually do? Well, on the bullish side, you have analysts from firms like JP Morgan. They see the recent market dip not as a reason to panic, but as a healthy and totally natural reset. Their advice is pretty simple. Ignore the short-term noise and focus on the big, long-term growth stories like artificial intelligence. But then, on the bearish side, firms like MFS Investment Management are pointing out a major risk. They argue that the market's performance is dangerously concentrated in just a few giant tech stocks. And for any real correction to happen, they say, it's pretty much a mathematical certainty that these giant stocks will have to fall. These two very different viewpoints lead to two very different strategies. The aggressive path says, hey, double down on tech, maybe using ETFs that track the big names like QQQ or the chip makers like SMH. The defensive path says, whoa, let's shift to more stable sectors like healthcare with something like XLV or consumer staples with XLP to protect against a potential downturn. And all of this brings us right back to the present moment, a market in a state of perfect suspense, just waiting for a single event that could tip the scales and become the one true deciding factor. So to sum it all up, November 19th was a day that was just completely defined by this tug of war. On one end of the rope, you have the powerful, forward-looking optimism for AI. And on the other, you have the very real, present-day fears of high interest rates and a slowing global economy. The market managed a small gain today, sure, but this stalemate is far from broken. Everything, and I mean everything, now hinges on that one earnings report. So the question we're all left with is this. With NVIDIA's results just hours away, which of these two powerful forces will finally win the tug of war?